Well, I'm back. Um, Forgot to make a video yesterday, and then somehow my alarm didn't go off this morning, so I woke up and the market had already opened. So, that's the joy of living on the West Coast. Well, it's nicer over here anyway, so whatever. Whatever. All right, so I got my wild hair on today because of the wild day in the markets. It's only wild in my trading account. In my long only account, good day. Made 25 basis points. Perfect. Made 25 basis points in a down market. So I think I made money in that account every single day this week. And that is simply from just kind of sitting back. I've got a panel over here that let me pop it out. Yeah. So this is what I look at. What's behind my head here is the dollar. But this has been keeping me safe. I ended up, so I started going into bonds again, and I just started selling the most expensive ones that I bought. So the ones that I bought, I guess, on the day before the Fed decision, I started buying bonds. Because I mean, unfortunately, I guess, like, being long bonds is kind of, at this point, it's like it's being short oil. And like, so Rao Powell pointed out a great point, probably the most poignant point that I've heard in a while, is that oil has already rallied 300%. And if oil goes from 100 to 200, it's only 100%. So we are past peak inflation, or it is right now. And so there's a difference between being right and being early. And unfortunately, I think we're just early. So I was selling the bonds that I owned that were down the most, still maintaining a position in bonds, but then I actually ended up buying the inverse leveraged bond ETF, TMV. Just kind of to hedge out my risk. Again, it's really frustrating because, like, like, we are past peak inflation, but the market has to price that in. And I was telling my partner yesterday, it's incredible how skewed the market can get one way or the other. And that old classic saying that markets can remain solvent longer than you can remain markets can markets can remain insane longer than you can remain solvent. Whatever. Basically saying that sometimes it takes a while for the market to price things in. And so what we're looking at, like, by going long bonds at this point, it's a change in the macro environment. And I ended up, yesterday I bought a call in TLT for January, and it is the which one is it? Which one? It is, yeah, it's the 120 call. And I'm down 9% on it, and I'm not going to add to it until it gets positive. But that's the thing, like, I know it will, because we are at peak inflation right now. And the report just came out that said, like, used car or vehicle prices fell the most, like, in the last 6 months or something like that. So things are coming down. And when we're talking about inflation, we're talking about transitory. It's a rate of change term. So the level may stay elevated, but that rate of change to get to that level, if the level doesn't change, that rate of change goes down to, like, zero. So if it's flat year over year, that rate of change is nothing, but you're still having to shell out whatever that absolute level is for things like food, energy, rent, those types of things. Rent's probably going to keep going up, and wage pressure is going to keep going up. So, yeah, so those are the things. So we are. I'm convinced we are at peak inflation, if not a little bit past peak inflation. So I'm comfortable with my TLT call. I can only lose what I spent, and you know, I'll have more money coming in soon, so it's fine. It's fine. All right, so let's go through the charts. We got the S&P futures here. I mean, it's bearish. It literally is bearish. It's hard not to get caught up in the short-term nature of the market. And so let's zoom in on the daily chart. But yeah, this was the day. This was the day that the Fed raised interest rates by 0.5%. But then Jerome Powell said, at the moment, they're not looking at a 75 basis point rate hike. And so on that news, for some reason, the market just ripped, and then the next day gave it all back. So that was kind of funny. Today, another down day. In my long only account, like I said, I made 25 basis points, and that was mainly from the inverse ETFs. So TZA, SQQQ, WEBS. What else? I think those are the main ones that I had, but I started taking those, I started selling those to realize those gains. And then I saw like how much I was up for the day started going down. And so I started adding back some different inverse ETFs, because in that account, I can't day trade in that account. So, because I'm still building it up. So I ended up adding on like a European short, an emerging market short, an industrials short, so SIJ. What else? A consumer short, so I think it's SCC. So I did that, and yeah, I was up 25 basis points today, so that's good. I got suckered into buying. Well, sure. Let's just be honest here. I got suckered in and bought XLE, XLU, XLP today, and I think I finished down on. No, I did not buy XLE. I bought GTE, which is Grand Tierra Energy. So it's an oil and gas. It's a cheap oil and gas company. And I think I finished down on that position for the day, but I'm almost convinced that's one I just need to hold, and it's a small position, so it's not even. It's probably a third of my regular position sizing. Let me think about that. Let's see. Let's bring the old calculator out. Okay, so it's a little over 1% of my account. So whatever. I'm in the inverse leveraged ETFs, so if oil goes down, I'm sure the market's going to go down with it. And so I'll make up whatever it is, but GTE, let's look at the chart. Bullish on the monthly. It is losing some momentum, but it's consolidating here on the daily chart. So I got in on it today. It's not convincing on the daily, so I violated my rules with that, and it's not convincing on the 4-hour, so I violated my rules on that as well. So let's just acknowledge that. But small position. If it dips, I'll probably just add to it. So let's keep going through the charts. Here's the NASDAQ futures. So Yeah, you can see that. So I put this green line here because it looks like that could be a bounce area because there's some looks like there's some it's tested that area twice, three times, if roughly four times, right? Charting is kind of subjective. So, might look at some individual tech names, um, or not. I mean, this thing's bearish, so and it can go down a lot more. Like, there's no reason not to expect that like it'll give back literally everything over the last 2 years, especially if the housing market goes under, the consumer goes away, the Fed hikes rates, the Fed tightens, the dollar goes to 110 or even higher to 120. That I mean, it could fall a lot. So we will see. And if rates keep rising, like if we are in a new environment, and rates keep rising, the Nasdaq could give back everything. So that's why my long only account. I am never until the Fed starts easing. I am not. I'm gonna sit with 50% cash all the time. So, looking at the Russell 2000, very similar, very bearish. Might get a little bounce here. So we'll see how this lower Bollinger Band on the monthly, how it responds to that. But I think you've probably got some support somewhere in here, around 1457. So the dollar, I guess apparently it finished down today, but showing some strength. I haven't added to my position, and in fact, I trimmed a little bit more today because I thought we were going to. I don't know what I was thinking, I guess, but so I do want to see a pullback in the dollar. If anything, I would like to see it come back down here to this area, this 102.3, and I'll add more. But I'm really loading the boat if it gets anywhere between 98 and 100. Like, incrementally, but I will get to 12% of my account in the dollar. Gold, I nibbled a little bit more today. So I'm using GLDM, the gold mini share ETF, just so I can stay liquid and not have to spend so much for the GLD ETF. But it looks okay. Starting to build a little bit more momentum, or at least that negative momentum is going away. Doesn't look great on the monthly chart, but gold does okay in a negative rate environment. So here's the 10-year yield. Again, bullish, bullish, bullish. So that's why TLT went down today. That trade, long the short end and short the long end, like I may just have to put that in as a hedge. Oh, well, unfortunately, on Thinkorswim, you can't short, or at least I can't short TLT. So that one may be one that I have to do long SHY and long TMV to recreate that trade. Here's crude oil, super bullish on the monthly. It just broke out of the squeeze on the daily. So we'll see how that goes. Yeah, and then on the 4 hour, not terribly convincing, but it was up 2% today. Natural gas finally having a pullback. Might take a shot here at 7.6. But really, I definitely want to see it come back down here to $6.50. $6 is an incredible bargain. And if it comes down to 6.5, I'm gonna leave a little bit of cash specifically for natural gas because there may be some panic sells, and it might drop down to 6. So that's definitely something to keep an eye on. And then we got the VIX still above 30. So the thing with volatility is the higher it stays, the higher it stays, and the higher it goes. So it is a mean reverting instrument, but the longer it stays up, it's not going to go down as low because the average, if it's a mean reversion to the average, a reversion to the mean, the longer it stays higher, the higher that average is. So, yeah, I mean, I don't have a problem if it goes either direction at this point. Because I think if the VIX goes down, I think there's a good chance like TLT starts going back up. Because I think the move index, I'm not sure if Thinkorswim has the move index. No. Yeah. No, that's not it at all. So, yeah, so the higher the VIX goes, like my long only account, I'm fine with that. Because I do own the dollar and I do have some inverse ETFs that are going to do well if this goes higher. And then I do have some equity longs in utilities, staples, and individual energy names. And I do have the midstream pipeline ETF that I haven't touched and I never will touch. Not for a decade, I'm pretty sure. So that's just going to be my preferential equity until the Fed turns around and has our back. And then I might start getting into some growth names. But I mean, I think AMLP is just going to be a good place to park some money. And over 10 years, like it may have one of the best risk-adjusted return profiles out there, especially if you reinvest dividends, because that thing pays a fat dividend at the moment. So Tesla, the souffle, the accounting fraud. So it's bearish again. Bearish, clearly. Really had a good day on FOMC day, but it gave back more than what it went up, and then again it went down again today. So, it's bearish. Bitcoin's still working its way down. Another loss of 0.5% in value today. Yeah, a couple levels here potentially. So 3,500 looks like a significant level. 3,000 or 30,000 is a significant level. And then, yeah, you've got your lower Bollinger Band at 17,000. So, again, story is going to stay the same. I'm not touching it until the Fed starts easing. So wheat, I've been watching this one for a bit. Wheat is on the verge of a breakout. I think if it does pop above this upper Bollinger Band, I think it's going to start heading higher. But we'll see because, Yellen Yellen's playbook is get the dollar stronger so that commodities go down and all the money in the world comes to the US or seeks out the dollar. So that's her playbook. She did that when she was the head of the Fed. So that's likely what she's doing again. And so yeah, so with any commodity position, you have to keep that in mind. Other than probably like oil and natural gas, but you never know, right? Because with the nature of demand destruction in commodities and how high prices are the cure for high prices, it takes the escalator up and the elevator down. Or so they say. But soybeans look pretty bearish right now. So that's interesting. I thought we were going to get a little bit more of an upswing, but apparently not. So again, this is a good example of why you need to have confirmation. You need to have a couple different methods of confirmation. So again, on my charts over here on the other screen, I've got a like a 9-day moving average. It doesn't really mean anything, and like people try to sell you on different moving averages of different lengths and whatever, but you know, it seems like it lines up well with my MACD indicator, my squeeze indicator, and my Bollinger Bands. So when it gets above the 9-day moving average, if everything else is lined up, it's time to take some risk. But at the moment, it's not. Nothing looks good on soybeans. And copper, yeah, just looking terrible. So the thing with copper, it's going to be instrumental in the green revolution, that electrical vehicle revolution, the new energy, that type of stuff. But the big difference is we're not bringing China into the economy or into the global market again. They're already here. So Raoul Pal was saying that, like, a good thing to keep an eye on is when are we bringing India into the global market? When are we going to bring their demand online? And so we're not there. And he was suggesting it may be at the end of the decade. So kind of when we complete this fourth turning, that's probably when this commodity super cycle really starts to manifest. But until then, all the big players are already here, and we don't have any money. So we're going to have to figure that much out. And tips. Tips and bonds are oversold, but here's the trade. Here is the steepener trade. Long the short end, short the long end. And of course, trade that, it's got to pull back, right? But from that monthly chart, shoot, long Chinese tech and short American tech, like, that is such a tasty looking trade. So I guess I'm just going to have to sit on my hands until this trade, until the MACD gets like down here, kind of like it did over here at the end of March. Just going to have to wait till we get till it gets oversold on the 4-hour and then go long. Because China's already gone through their recession. And so they're likely to be coming out of it. With my limited knowledge, the only thing that could like blow this trade up would be the dollar going to like 120. So then I think the trade is just like long the dollar, long the VIX. Have a good day. And there's no shame in like making a little bit of money, right? Because you made money, whereas most people are going to be losing money because most people are chart chasers, trend chasers. They're influenced by people on Twitter. They don't understand rate of change. So growing slower that means something. Growing doesn't necessarily mean anything. Growing faster, growing slower, slowing faster, slowing slower. Those mean a lot. And so I don't think a lot of people really appreciate that much. And so, we shall see. But again, like people are chart chasers. That's why the ARK ETF was up like 8% on the FOMC day, and then today it's down another 4%. But it's up that 8%, sold off. I think it was down like 9% the next day, and then down another 4%. But it went below 44 for the first time this year. So we'll see. Like I buy into Kathy Wood's narrative. I believe all that stuff. I believe that technology is going to revolutionize a lot of things, but in the meantime, we have to secure our energy, we have to secure our food, we have to secure our financial situation and financial system. And that means like we got to work out our logistics, we got to work out our population, we got to work out our tax situation. We got to renegotiate with other countries, and it's like Peter Zeihan had a good point that it's easier to just build your economy off of fossil fuels because you only have to really deal with like 5 other countries that you don't agree with, whereas in the green energy situation you have to deal with like 60 different countries. So there's going to be no support for sending American troops to defend American interests in 60 different countries. You're going to have to like spread the wealth, which we know like that ain't going to happen. And so it's just we got to put this new technology exponential age, we have to put it on pause. And if it truly is exponential, then you'll have a chance to buy it again. Like the fact that it's exponential doesn't really affect that you'll have a chance to buy it again. When the trends change, that's when you'll have a chance to buy it again. But you'll have a long chance to buy it again. So like you had all of 2018, all of 2019, all of 2020 to buy ARKK, and you could have realized profits so many different times during that time period. But this and Bitcoin and Tesla and all of these things that are too good to be true, that essentially promise like absolute democracy, inclusion, diversity, all these great things that we have to strive for. Unfortunately, like when you are energy insecure and food insecure, like you can't have these things. And unfortunately, that is where we are in the world, because boomers are exiting the economy. They are exiting with their capital, which is why money is becoming more expensive, as the bond market has shown, and then the Fed followed suit. And money's going to become more expensive. And so, what the markets are doing right now, it's a clearing mechanism. And there's a difference between kind of like the credit markets and the equity markets. The equity markets, they do follow that free market principle where good companies yeah, their stock price and market cap may take a haircut, but I mean, you're going to be fine buying Microsoft. Like Microsoft is still going to be a strong company on the other side of this. So is Amazon. Unfortunately, some of these companies that are in the ARC portfolio, they may not be around when things start getting better. So that's the great thing about like the equity markets is there is a clearing mechanism. So when things get overbought, you start to look around and you start to take inventory of like what is actually producing value here. And unfortunately, it looks like not much in the ARC portfolio is actually producing value. And unfortunately, I hate to say it, but it's like Tesla might be the most valuable thing in the portfolio. But and then when we look at like the credit markets and debt markets, there's not necessarily that type of clearing mechanism because like the way that we've gotten out of like recessions and depressions before is to spend more money. So the solution to debt is more debt, and that like that gets out of control. So a little bit of a rant on this Friday. Let's put it this way. Okay, what am I bullish on? Right. Let's take this in a different direction. I'm bullish on the dollar. Okay. I am a little bit bullish on gold. I can't help but be bullish on yields. Like I do think we are at peak inflation or a little bit beyond peak inflation. So like my portfolio kind of reflects. So with the addition of TMV into my long only account, I guess it does support that I am bullish on yields. However, in my trading account, I do have the long call option on TLT. So maybe that's the pain trade, because pain trades are always something goes lower. So you have to have a little bit of that pain trade on at any one time just to kind of make sure you're going to make money in any environment. But for now, it looks like yields are still going up. So I got to live with that. But I really thought that yields were going to go down. And so Raul was hinting because Raul, he's bearish on yields. He thinks that there is a chance that yields fall quickly and it just absolutely takes everyone out back and beats the shit out of them. So we will see, and that's literally all you can do is sit back and wait, because this is how you take risk, take bets. I am bullish on crude oil. I'm bullish on natural gas. But we're not at a point where I would feel comfortable taking a full size position in any energy company, or the XLE ETF, or the XOP ETF, or the OIH ETF. However, midstream pipelines, different story. I am bullish long term. So, yeah. Just looking good on the monthly, looking fair on the daily. Yeah, it looks good on the daily. It's above the 9-day EMA. So, like it's going to be volatile, but like pipelines are going to transport the blood of the economy. And so, we have to keep developing our oil and gas resources, and pipelines are how you're going to transport that, because the basins are not where the people live. The Permian Basin, it's West Texas, it's southeast New Mexico. There's not many people that live there that don't work in the industry. Dallas is kind of sitting in a basin, an oil and gas basin, so that transportation isn't very far. But the Permian it's a better play than I forget what the name of the basin is that Dallas sits on, but Permian's a better play. Austin sits on the Austin Chalk. San Antonio is pretty close to the Austin Chalk and the Eagleford. So you've got those. But still, the moneymaker is the Permian. It's where the cheap oil and the cheap gas is. And you've got the Bakken where, no one lives there. So you're going to need to pipe it out. But then the crown jewels are the gas that's in the Appalachian Mountains and the Appalachian Basin. So that's got to be piped because the terrain is too hard to develop big cities. You've got Pittsburgh there, and that's really about it. And New York State doesn't want pipes, so don't know what to tell you. And New York is not going to go after their Marcellus or their Utica. And I don't know how much Utica they have in New York, but I do know they've got some significant Marcellus shale. Pretty sure. But they don't want to go after that. So, they are going to be forced to pay higher prices. And, with kind of what we're seeing with this Roe v. Wade discussion is that states' rights. So I think how states handle energy is also going to kind of fractionate. So I do think pipelines are, again, I'm super bullish long-term on pipelines. So is Buffett. And that's really all I have to say about that, is that states are going to handle it differently, but we're going to need pipelines until we get on the other side of this, until we get through this fourth turning. We are going to need to develop all of our energy sources: conventional, unconventional oil, natural gas, solar, wind, nuclear, geothermal. We gotta tidal. We gotta develop all of it. The worst one that I can think of are dams, and unfortunately, up here in the Pacific Northwest, that's where our electricity comes from. But it's going to kill the biodiversity upstream. And the case in point is there used to be salmon in Idaho that would swim up the Columbia River. Unfortunately, the Columbia River has 12 or 22 dams on it, something like that, something insane like that. And, it's a place like the spawning grounds way, way inland where you used to have hundreds of thousands of salmon. They're having to use fish hatcheries, which presents its own issue. And the big problem with that is that they can't even get back upstream either. So they'll go out to the ocean. They're spending less time out in the ocean, and then they can't make it back up because of all the dams and the fish shuttles that they've built. They don't work. And so they're having the same issues in the Bay Area, and they're having the same issues up in Washington. So, so I'm bullish on every other type of energy besides dams. So, that is that. A little bit of a rant, but that's kind of how I see the world. I do like the Western Hemisphere. Bullish on the Western Hemisphere. I'm bullish on America. Bullish on Mexico. Bullish on Canada. Bearish on East Asia because they are going to have some energy problems. Bullish on India. Bearish on China. Fairly bullish on Australia. Not quite sure Not quite sure what to think about Africa though, because they've got everything they need, but the political and genetic trauma that they have there, I think it's going to be difficult. And then Europe, I think Europe's just going to stagnate for a while. So that's kind of how I'm looking to invest. You wanna if you're gonna have a long only fund where you actually buy and hold. So like I trade my long only fund, but if you're gonna have a buy and hold fund, you are going to want to find industries and products that are very energy intensive that can create bottlenecks, and you're going to want to find the American version of that, because we've got the best setup going into the next 10 years of any other country. So that's awesome. But, you know, it's not going to be great for the rest of the world. But, all right. We will be back on Monday looking at charts. We will see what happens in the futures market. There's a chance that the S&P bounces because it has been some pretty intense selling. Everyone flipped bullish on FOMC day, and then everyone flipped bearish immediately the next day. So, if anything, you have to hold a ton of cash in this type of volatile environment, because VIX above 30 is, it takes hedge funds out, and they've actually got like incredible resources. And so it takes hedge funds out. And if you think that you as a retail trader or investor have insight that they don't, then you are fooling yourself, because they do like insider trading. So if it's taken those types of groups out, then you just got to be careful. And that's what VIX at 30 means. And if you're looking over here at the monthly chart on the VIX, that thing is bullish. So this does not mean that we're gonna have like a huge market crash, but it could mean that we have prolonged periods of selling. So it's gonna feel like a market crash just without the excitement. But if it penetrates this upper Bollinger Band, don't be surprised if there is a market crash. So that's that. See everybody on Monday.